All right. Welcome everybody. I hope you can hear me. There's a couple more people just trickling in right now. I'm Jake Rushton with True North Retire. We've got our whole team on this call, and we're going to be really hopefully efficient with your time and get you all those things you're curious about when it relates to the 401k and the new CARES Act. So quick kind of just make sure you know how Zoom is working. We have a chat going, so you can respond and ask questions in the chat, be the best way. And as you do that, we'll get to all your questions and make sure we answer all those. And so please put your questions in there. It's just at the bottom of the page, whatever you're on your phone or your computer, there's a chat button. So please use that and let us know what your questions are. So just by way of introduction, we have obviously Marty Watkins, founder of True North, on the line, as well as our whole advisor team. So we have Jared Empey, Sam Watkins, and Richard Hopkins. A couple more people coming in. And so we really appreciate you being here today. And we know there's been a lot of different updates and news, and we wanted to give you the best help as we've been meeting privately, trying to understand all the new regulations that are coming out. And we're going to talk about the coronavirus and in a way of talking to you as a participant in a 401k plan. So whether or not we are managing your 401k or not, we want to help you understand what it means for you. If you're in a different 401k or have another 401k somewhere, or your spouse does, we want to help you completely understand all the new regulations. So appreciate you taking that time today. I'm just letting everybody in. We've got a few more people jumping on. So I'm going to get started. I'm going to share my screen and show you a presentation. We've got just a couple slides with a lot of data. And again, we will follow up with all of this information. Will get emailed out to you. We're going to put it on our blog, on our website. We're going to put it on YouTube, so you can have access to all this later on. So you don't need to worry too much about notes. But we wanted to make it effective as possible, get you all the information, but make it applicable to what is most important to you. So the CARES Act, let's talk about that. The CARES Act, what that stands for is the Coronavirus Aid, Relief, and Economic Security Act. So that's what the CARES acronym comes from. It was enacted on March 27th, obviously from what's going on. And it had a lot of interesting aspects to it, especially relating to the 401k and giving you access. So the first thing I want to touch on and what it means to your 401k, and we're going to cover all these different things about your 401k. And the first thing being, looks like we have a little typo. That should be number 1, 2, and 3. Apologize. The coronavirus-related distributions are now known as CRDs. So we're going to talk in depth what those mean to you. The plan loan provisions have changed in your 401k, and then the required minimum distributions. So let's jump in. I'm going to make sure that we have everybody admitted and everyone's muted. Okay, and if you can just put your questions in the chat, that'll help us a lot so that we can kind of keep through all of the content we want to share with you. I think we're good to go. All right, so let's talk distributions. Give me just a second. Okay, I got the chat pulled up. Okay, so corona-related distributions. Now, first and foremost, I want you to understand that the reason for the changes in the CARES Act were to allow you to get access to your 401k money in a distribution. Now, this is optional for the plan itself. So I want to make that very clear. If you need to take a distribution from your 401k related to what we're talking about, you need to make sure your plan has been changed and you have the entirety to do that. So if there are those of you that we manage your 401k, let us know. We can make sure those updates are made. It's very simple. So if your company hasn't done that yet, I'd be surprised. Most of them have been adding that. And so this provision should be applicable to you, but you want to check and ask your HR or your CFO, whoever's in charge of your 401k. But the key to it is typically your 401k has a penalty if you take money out before the age of 59.5 years old. So that penalty was 10% in addition to any personal tax. So what the coronavirus, the CARES Act enabled us to do is take that money out without a 10% penalty. So that goes away, and you have to qualify for this ability to take money out. The qualifiers are right here in the middle of the screen. Just making sure there's a couple more people coming in. All right. The first thing is obviously, let me go back a page. The first thing is obviously if you have COVID-19 or coronavirus or someone in your immediate family does, that's an immediate qualifier. The second would be any dependent. So anyone in your family is, if that they've impacted, they have it, they've tested positive, you can take a distribution. The third, everybody. Okay. The third, apologize, there's a few people not muted. All right. The third would be if you've had a financial hardship from the coronavirus. So this is kind of a gray area, and you're the one as the employee that gets to determine if this impacts you. So that's if you've lost your job, or you've been furloughed, or your income has been reduced, your hours have been reduced. So I think for the most part, a lot of us in some way, shape, or form have been impacted financially from COVID-19. So that's where I would say most of us would qualify for a distribution should you want to take one. And the distribution limits have increased. You can take up to $100,000 out of your 401k, and that's avoiding the 10% penalty. However, you want to be very careful about this, because if you take a distribution out, you will be taxed depending on if it's Roth or traditional. So talking more in depth about that, you won't have the 10% penalty, but if you take out, let's say you take out $75,000, just for example, you can spread out that tax liability over a 3-year period. So let's say you take the $75,000 out of your 401k to help pay for whatever bills you need to during this time. You can actually realize $25,000 over the next 3 years instead of all one lump sum, which would most likely bump you up into a higher tax bracket. So you need to know where you are on taxes, and you need to have a deep conversation, I think, with your accountant or your CPA or your advisor on the True North team to help you understand better what that impact would be from a tax side of things. The great thing, though, is in addition to spreading out the tax liability, you can also repay the money or roll it back into the 401k and avoid the tax over a 3-year period. So in that same example, if you took $75,000 out and things started to come back and you had the money to put back in and you put $50,000 back in, you would only have to realize a $25,000 income for your taxes in over a 3-year period. So there is some flexibility there. And just the key to this distribution policy change in the CARES Act, I think, is really to understand that you can get access to the money. Whether or not you should is what we want to dive a little deeper on. So I'm going to invite Jared Empey from our team to kind of talk about the pros and cons of if you were to take a distribution during this time, what would that really mean, and why maybe you should or shouldn't from an advisor perspective. So I'm going to, hopefully Jared, you can unmute yourself, but I'm going to pull you up here. Oh, you're unmuted. Yep.
Thanks, Jake, and welcome everyone. Hopefully everyone's having a great day. It's pretty toasty here in Boise today. It's going to be 88 degrees, so it's pretty nice. But yeah, what Jake's talking about here is part of the new Stimulus Act. I want to be very clear, should be, as recommended, a last resort option because it's just going to dramatically impact your retirement nest egg. Now there could be some good opportunities here depending on your level of income for the year, if it's been drastically lowered, and potentially just taxing some of it right now if you're in a lower tax bracket and doing essentially a Roth type conversion with some of that money, things like that. Jake, can I share my screen? Are you able to make me the host to do that or something?
Yeah, you should be able to. Let me make you a host, and that'll.
Because one thing I want to talk about and show here is the impact that taking a distribution can have on your accounts. Now, these distributions, kind of like Jake was saying, is for the 401k, 403b, and IRAs, pre-tax IRAs. Those are the easiest ones to take these distributions from. The 457s are a little bit more complex. They have some tighter eligibility reasonings there. So just be aware of that. So if I share my screen here now, what I want to show you is that $100,000, if you were to take out $100,000, and this is looking back to the 2008 period, but the teaching fundamentals are still the same here. So in 2007, if you had 100,000, or if right now you had 100,000, and let's say, you experience this dip, that 100,000 maybe today is S&P still down about 14%, Dow still down about 17%. So that's kind of give you a general idea of where markets are still at from their highs in early February. Well, if you were to stay in the market and not take a distribution, because even though these coronavirus related distributions, if you pay them back within the 3 years, they're not subject to any interest, unlike the loans, which another advisor will talk about here in a minute. However, that's not completely true, because the interest, in essence, that you would be charged or losing is the earning potential. So you can see going forward, if you just stay in, it grows over the next 10 years up to 238,000. If you take that coronavirus related distribution, let's say, and you pay it back within 1 year, you can see that there's about an 83,000 differential there. And if you take that coronavirus related distribution, just decide you want to keep it in total, pay the tax on it, and not put it back into the market, you can see that you're going to be losing quite a bit on that. So the earning potential of taking these distributions are quite drastic. And that's why if you can resort to other areas of taking distributions first, such as your emergency fund, maybe some after-tax investments, that would be priority before dipping into your retirement accounts, unless, like I mentioned, we can take advantage potentially of any Roth conversions. But that's going to be probably a slim few of you, and that'd be based on your each individualized AGI. So that's kind of why you want to stay away from these coronavirus-related distributions, if at all possible, just because it has such a huge impact on the growth of those. Jake, I'm going to make you the host again. Can you go back to that screen? There's just a couple other items that I wanted to point out again. If you can go back to that slide for everyone.
Yeah. Let me pull it up here.
Great, thanks. So again, the repayment is over 3-year period. You can choose to repay that at any time, really, there, and just work with the accountant to make sure everything is cleared up in terms of you repaid it properly. Again, it's not going to be subject to that early 10% penalty, which is huge if you're younger than 59 and a half. If you need the money to do that there. The distribution up to 100K per person, just know that that is 100K per person, not per account. So if you have multiple accounts that you're taking from, just know that that's a flat amount across all accounts there as well. Now that's basically all I have on that, Jake.
Okay. All right. Thanks, Jared. So distributions, again, 10% penalties waived. You have 3 years to really realize the tax. So I think that's kind of the key things to know, and realize that there might be some better methods to get access to money, but there is a way now to make it a little less costly from a penalty standpoint to get access to your 401k money. So let's talk loans. That's another way to access your money. And it's pretty interesting what the rules have done there as far as the loan. I really like it because if you were already in a loan, one thing that I found really interesting was that if you had a loan outstanding, you can defer making payments for a year. So that's another helpful part of the CARES Act. If you have an outstanding loan, you don't have to keep paying for the year of 2020, which I think can really help a lot of people through this tough time. Again, the loan provisions are optional. So your plan has to add this as an option to get loans and change some of the rules that are allowed. So one of the key things they did change was increasing the limit of what you could take out of your 401k. So historically, what you've been allowed in your 401k is simply 50% of your vested balance. Now, again, that's your money is always yours, is always vested, but the company match can have anywhere from an immediate to a 6-year vesting schedule from your hire date. So that has increased or doubled now to 100% of your vested income or your vested balance, or $100,000, whichever is lower. So that's key to understand the loan provision. Now your plan itself will have a very specific interest rate that you'll be paying back to yourself. It's typically based on prime plus 1 to 2% is what we typically see in our 401k plans. So you'll still have to pay back the loan amount plus interest, but that interest is always applied back to your account. That doesn't go to somebody else. It comes back to you. But again, going back to what Jared just covered, it is out of the market when you take a loan. So you're giving up that opportunity cost of having the money invested in the market for what we hope to see, continued growth from what we've seen from the drop in March. So repayment extensions. So it's optional
Jake,
to defer them out 1 year.
I don't know if you can hear me.
Oh, Marty, you there? Yeah.
Yeah, I just wanted to mention that what you could do with a large enough balance is adjust the bond portion of the portfolio and essentially make up for that and keep it in the market and at least mitigate the opportunity cost portion of it by increasing the stock level of the portfolio. So if you took out 100,000 and you've got enough in the plan that you could increase the equity level to essentially match whatever the allocation was. Let's say it's a 60-40 portfolio, increase the stock portion by 60,000 on a $100,000 loan, then you could essentially capture that opportunity cost by increasing the equity level. So there's some ways to at least mitigate it. It's still not an overly favorable route. It should be kind of way down the list as far as methodologies, but that's one way you can at least mitigate the opportunity cost issue.
Right. So you're basically saying, look at the loan as the fixed piece of your 401k and then increase what's left in the account in the stock.
Right. That's right.
Okay. Exactly. So yeah. So understanding how you're investing your 401k is key, especially if you're taking a loan out. And the reason you treat that like a bond is because you're paying yourself interest, which has a fixed return. So yeah, that's a great point, Marty. So if you're taking a loan, if you have a loan outstanding, know that there's some ability to defer those payments. So that is could be a better method. There's no penalties involved with the loan, obviously, but do remember if you leave your job or get furloughed or laid off or something, and you have an outstanding loan, you typically have to pay that immediately back. So otherwise it's treated as a distribution. So in the event, if that happened in 2020, I think you're going to have a few options to work through that would help you avoid the penalty. And we'd want to look at that a case-by-case basis to help you best navigate that if you had a loan outstanding and lost your job. So just know that a loan, there's some different things you can and can't do around those. A lot of people take loans out to purchase a home, for example, like as a down payment. That still can be it can work. I would run the numbers and make sure that it is the most applicable place to pull money from. Marty, I don't know, do you want to discuss a little bit about maybe some other options or really why you would maybe want to or not want to take a loan from your 401k? What other things would you kind of recommend people try and do?
Well, it depends on if you're the business owner and things like that, but there's a lot of reasons why you wouldn't want to. You have to kind of come up with a few reasons why that's the source, the kind of the last resort place that you would draw from. And I can think of scenarios where, okay, you've been so financially devastated from an income standpoint in 2020 based on the pandemic that your tax rate's going to be, let's say as a business owner, it might be net negative. So you could essentially, but then I would take a distribution and pay the tax on it and get your, let's say, I don't know if we have any developers on the WebEx, but if they have negative taxable income, they could take a distribution without penalty and go up to essentially a 0% tax rate. And that's a scenario where a distribution would make sense, not a loan. Or, I mean, there's some scenarios where it can make sense. If that's the only way you can stay in your home and not be foreclosed on, things like that, then sure, it's a technique. But most people have other methods of bridging the gap. And if there are other methods, they're generally preferable.
Yeah, I think the key to that is if you do take a loan, it comes out of the market, so you're not going to be participating what possibly we see some improvements in the market. However, I think with other, if you need the money for specific day-to-day bills, I know there's been a ton of relief given by most of the large companies as far as mortgages, delaying those payments, and other bills I know have been easily kind of deferred for 3 months and really without any penalty. So maybe think through and use some of those tactics first before you take a distribution or a loan, I think is what I've been most helping people do, because even though there's not a penalty or you're paying interest back to yourself, there is the risk of the market, which it's up again today. So it continues to climb back up. I think we're still above where we were in last October. When we talk about this massive market crash, I think taking a bigger long-term perspective of the markets is important, because when you look at even just the S&P 500, the top 500 companies, we're still extremely high from where we were in 2008 and 9. This just happened really, really fast, which caused a lot of fear and panic, which the media is really pushing. So
I would say in general, if somebody's thinking about doing either the loan or the distribution, that really they ought to talk to somebody and work through why that's the best solution, and in all likelihood they'll figure out something better to do, wiser to do, except for the weird scenarios where you have negative taxable income for the year, where you could essentially post it all as taxable and not pay any tax on it, or perhaps stay in the 12% bracket. And take the distribution. So it's a pretty rare set, either the desperate or for strategic reasons that developers have. We've got quite a few as clients. If they've got wild swings in their income and this year's going to play out poorly, this gives us an opportunity to essentially shift things around quite effectively.
Yeah, I would even ask Marty, what would you say to someone that's maybe close to retirement, was about to start living off of some of this 401k money possibly? What, in this scenario, what would you suggest kind of thinking, maybe change a little bit of their strategy in that scenario?
Well, hopefully their allocation is already set for retirement, and then I would certainly not use money in the plan as long as their income is above 12% and the 12% tax rate, and let the portfolio rebalance and do its thing. And in effect, if this functions like many recessions, quite rapidly, you end up being above where you were, your previous high watermark, within a year. In 2008, it was 30 or so months before you were ahead of where you were at the peak before the crisis occurred, before the dominoes started falling with Lehman, et cetera. So from an investment standpoint, I would stay the course, let things rebalance. If you're 80% in stocks and kind of too aggressive for retirement, I wouldn't get more conservative now. But if you're already in a 60-40, I'd just, or 40-60 or 50-50, I'd just let it go. If I was in a 40-60, I might get more aggressive, actually. But I think you're asking about the loan side. And the loan side, I think it's a rare enough thing that when it really makes sense, that I would say anybody listening should probably seek counsel before they would actually pull the trigger on that methodology being the best technique.
Yeah, it's good, I think, because everyone has a little bit different scenario depending on if you're a business owner or you are just being paid W-2 income. There's a lot of scenarios that can shift when you should or shouldn't take this money. So don't always jump right into, now that the CARES Act allows me, I should do it.
And part of me likes the flexibility of the distribution and the 3-year payback more than the loan. I mean, they both have kind of pluses and minuses to it, but depending on the situation, the distribution without the 10% penalty kind of like is freeing up money to be an after-tax account. We'd normally think of this in terms of Roth converting. Interestingly enough, it kind of functions like that without the Roth on the other side. But that begs the issue of, should I just then Roth convert instead if you have other IRAs? And so there's a lot of planning opportunities, and it ends up with most people that are considering moves like this that are clients of ours or clients' employees, there's enough variability and options that I think it should be discussed with somebody that is looking at the whole picture before you really choose to either take a loan or distribution.
Yeah, and I think that's definitely a key thing to do, just so that you can talk through the scenario and get a little bit more guidance personally. And that, that's available to anyone that's in our 401k plans, that's obviously participating in those plans. We'd love to help in any way we can there. So yeah, definitely reach out. When we follow up with this after this webinar, we'll get you all the contact so that you can get a hold of us and schedule a time to chat too. If you're thinking about taking a loan or distribution, let's talk a little bit about that. So let's, with that, quick reminder, if you have questions that you want to ask, you can put them in the chat. So click on that below. We're going to cover one more topic and then we'll go to questions. The last thing we wanted to discuss is required minimum distributions. So RMDs are, they actually just changed this rule back in December, where it was 70.5 years old, changed in the Secure Act to 72. And now with this CARES Act, RMDs have been changed even more. So there's actually a temporary waiver. So you, in 2020, for 2020 and 2019, you do not have to take an RMD that's due after April 1st. So we're going to talk a little bit about that. If you're in that scenario and you have been taking required minimum distributions and you don't necessarily need to take them, this is a great opportunity because you don't have to now in this because of the pandemic. But it does not apply, just so everyone's aware, it does not apply to cash balance or defined benefit plans. It's just 401ks, or what we call defined contributions. So money that you've put in that in IRAs and other accounts, 401k plans it's only available to 401k plans, not IRAs too. So 401k, 403b if you're in a government or a nonprofit, or 457, those are where it is applicable. And I'm going to actually turn over to Sam Watkins, talking about maybe the strategy behind why you would or wouldn't want to take that minimum distribution from maybe a decision or a tax strategy standpoint. Sam, you still on the call?
Yeah, I'm here.
Okay. Yeah. So you want to talk about that, kind of the RMDs, the change, and why, as an advisor, if someone's in that age now of 70.5 to 72, where would you kind of recommend people look for to decide to take that money out or not out?
Yeah, it's an important issue for a subset of people. If you're over 70, if you've inherited an IRA, if you have a loved one that falls in this category, and listen close because it may be potentially impactful. If not, go get a snack and come back in 2 or 3 minutes. One of the main purposes of required minimum distributions, or the government wants to eventually get their taxation. So they make you take out a certain percentage, and that percentage increases the older that you get. And the percentage of the balance at 12/31 of the previous year. And so one of the reasons that they waived RMDs is because the 12/31 balance for most people was a lot higher than the balance is now. And so the actual percentage is a lot higher. And so that's going to deplete these 401ks and IRAs a lot faster because it's really a higher percentage of what the actual balance will be.
Because it's based on the 12/31 value, right? So the end of last year, we were at a kind of a peak because of the market, and now we've dropped. So taking that higher number can really hurt you.
If you had a 401k of $1 million and you were supposed to take 4% out this year, you'd take 40,000. You'd be taking 40,000, but now your 401k might only be worth $800,000 today, and so that 40,000 is a higher percentage. And so they're trying to give people relief from that. And there's some strategies that can be implemented to take advantage of that. One thing that's of note is if you need the money from the required minimum distribution to live, you probably should still take some. You don't have to take the whole thing if you need all of it. But you might still, then that's kind of the end of the story. However, a lot of people don't actually need the money from their RMD to get by for the next year. So then what do? One strategy is, now that you don't have to take that required minimum distribution, you're going to be in a lower tax bracket. If that takes you considerably down to the 12% bracket, or sometimes even the 22 and 24% bracket, it can make sense to then Roth convert that RMD instead and put it into your into a Roth IRA or a Roth 401k to take advantage of the lower tax bracket for not having the RMD. For sure, if you have an inherited IRA, it's probably a good year to not take that at all, just because the money will grow faster, especially if you don't need that money as well. The Roth conversions are for sure the largest technique. The reason that you don't want to take the money out when you want to leave the money in longer is because 401ks and IRAs are a tax advantaged vehicle where you don't have to pay tax on the growth as you get dividends and interest and capital gains inside that account. Whereas in an after-tax account, you need to pay tax and all those things. And so you can reinvest what you'd otherwise pay in tax and you have a higher rate of growth. So you want to leave that money in there as long as possible. The only exception is the Roth conversion. So those are the main two strategies. If you don't need the money and you would otherwise have to take an RMD this year, then it's worth exploring either Roth conversions or leaving that money in there long term for it to grow. So, and if those apply to you, then please feel free to reach out to us. We're happy to break down some of those strategies for you. And Jake, I think that's the crux of what's important in this from my side.
Okay. And Sam, we got a couple of questions that came in. So I think this one is kind of related to what you were talking about. The question is about Roth conversion. So this particular person has been doing non-tax or after-tax accounts for a long time, but now they're talking maybe they should convert to an IRA. I'm assuming they mean Roth IRA. And maybe we can talk about conversions right now. Talk about converting to a Roth IRA. I mean, if it's an after-tax account, you really can't do that. It'd have to be from already in an IRA. But They also asked, would you be paying earnings on the withdrawal on how it increases? So pay tax on the continuing earnings. And if you're in your late 70s, is it too late to convert? So maybe talk around like Roth conversions and there's a few questions in there. I can repeat them if you need to.
Yeah, let me start with a couple of them. So first off, unfortunately, if you've got a sizable taxable account, the only way you can get money into any sort of IRA is limited to $6,000, $7,000 if you're about 59 and a half. Of earned income per year. So it's really slow flow to get in there. But once it's in an IRA, whether pre-tax or Roth, you can move money between them from pre-tax to Roth as much as you want. You just have to pay the tax consequences and pushing up the brackets. And so when you're in a taxable account, you're pretty stuck, unfortunately. A normal Roth conversion, so let's say you have money, either a pre-tax 401k or an IRA, to roll that to a Roth IRA. Let's say you moved $100,000 over, okay? And functionally that would just increase your taxable income by $100,000, and you would just pay ordinary income tax on that Roth conversion. And there's no age limit for that. So even in your late 70s, in a year like this year, it makes total sense to do some Roth conversions if that's where your tax situation lies. We're doing that with plenty of our clients in that age gap. What else did I miss, Jake, from that list of questions?
So I guess
I think one is, so can I just jump in on if somebody has an after-tax IRA, and let's say they've put in for 4 or 5 years, and based on market corrections, they've not made much money on it, and so their basis, let's say, is $24,000 and it's worth 26. It might be a great year to take that after-tax IRA that has 2,000 in gains and switch it over to a Roth. In a year like that, there's not many clients that are in that type of situation with an after-tax IRA. It would be something that predated working with us. But with that type of scenario, that would be it's a great time to convert that to a Roth to never pay tax on it going forward with very little income tax involved.
Yeah, so essentially a couple parts of that. There's getting the money into the IRA first. So you can do that either through your 401k, which has a higher income contribution limit of $19,500, or if you're over 50, it's $26,000 a year right now. You could fully fund that, but then down the road, you can convert that to a Roth, depending on if your plan allows or if you're retiring, leaving the company. There's ways to convert a larger dollar amount in a short amount of time using the 401k, more so than an IRA because the limits are only $6,000 there. Yeah, I think determining where your money is right now is probably the first question that I would want to have answered specifically, and then knowing, can we convert that to a Roth? Once it's the Roth, though, it's tax free. I mean, the growth and everything, you're not going to be taxed again on it. So, yeah, the question to answer that is definitely is correct. That you definitely wouldn't have to pay on the earnings in the Roth once it's there. Another question that came in. Let's talk about, and I don't know if this is something for Marty or Sam or who wants to jump in, but year-to-date market performance and what the current projections are for the remainder of the year. So tough question to answer what the projections are, but as far as year-to-date, Sam or Marty, do you know kind of roughly? I know today's up a little bit more, but I think we're in the teens as far as when you look at the whole year-to-date return, negative return versus what we were negative 30.
Yeah, I've got a performance report as of the 24th on a 50-50 portfolio, and the year-to-date performance is down 11%. So
Okay,
50% stocks, 50% bonds, they're down 11% year-to-date.
Which off of the low, I don't know what the 50-50 low was, but I know, I mean, the market itself was around 30.
It's well up from the low.
Side.
I mean, the low price for DFA Global Equity, the main equity component of most of our portfolios, was down to $15.70 a share. Its peak was $25.35.
Yeah. The S&P 500, when you ask how the market's done, the response is, which market are you talking about? Because there's plenty. Many people think in terms of S&P 500, so which is not as applicable to our global portfolios. But the S&P 500 is down about 10 percentage points from the beginning of the year. From its peak, it's down more than that because there was a lot of gains in the first 6-7 weeks of the year. But from year to date, S&P is down about 10 percentage points.
Okay.
And then
so as far as projections going forward, yeah, I guess maybe give some thoughts around how we're feeling.
I'll do my normal quote there. I think God knows, but God's not telling me. It really can vary a lot, and I do believe that those that really try to prognosticate these things make palm readers look good.
I totally agree with that. I think a lot of it comes back to what are markets fundamentally, and in some ways they're the most complex and powerful computers in the world, because what they are doing is they're incorporating everyone in the whole world that's involved in markets, their combined information into one price, because everyone has a price that they would buy or sell a certain security, and a willingness to pay for that incorporates all the information they know about that security. And so the market price is incorporating everybody in the market's expectations for the future. That includes expectations for whether a second spike of infections come, whether other more shutdowns come, whether we have a smooth recovery, whether stimulus is effective. So all those expectations for every expert, everyone involved in all these markets combined. And so it's really hard to guess better than what the market is. And that's why we don't try to do any market timing. But I think in truth, if future spikes in infections and shutdowns happen with greater frequency and severity than what the market expects, that would be the likeliest reason we'd have another drop. So I think we're all in a very unprecedented situation, and we'll just kind of see what happens. But what we all need to remember in times like this are that long-term expectations of return shouldn't need to change so long as we rebalance, we don't panic, we don't get more conservative or sell low as part of these tumultuous times.
Yeah, I think because I'm dealing with 401k participants, we don't nearly have as many knee-jerk reactions because you typically continue to put your money in your 401k and kind of don't check it daily. Most people, I know some people that do, but I think for the most part, the news is really, we've got to understand the motivation behind what the media is trying to do. Keep your attention. They need to sell more marketing dollars, so they need your attention. So they're going to really push as many things as they can that will get you to click on on whatever news story or watch it, keep your TV on, whatever it is. They don't necessarily have your best interest of what your investment should do. There's been some very positive days of recently. Today's one of those. And I think it's because we're seeing a little more certainty is, hey, things may start to open up in certain areas. There's a lot that can go around outside of that as well that can cause these reactions. But, you know, trying to time that will be near impossible because you'll have to time in and out. So it's better to have that long-term perspective and know that, if anything, try to do the opposite of what the news is trying to get you to do is you'll probably do a little better. But we never take this approach. True North's definitely not the place if you're trying to time on a daily basis and do those things. So if that's something that concerns you and you need to talk through it and you're worried and when you hear the news, please call or text any of us. I mean, we're happy to talk through that. We do that on a daily basis. So staying calm through this is the number one key piece to knowing, you know, what the rest of the year holds, because there's obviously a lot of regulation that's changing, like the CARES Act, that improves people's ability to feel comfortable with accessing their money if they need to. So I think that's a real tough question to answer, but hopefully that was helpful for those that were wondering those things. Is there any other questions that we could answer about the CARES Act, about your 401k, about, you know, the markets? We want to do this more often, especially now that we're all stuck at home, to help you, you know, get through this together and know that we're doing a lot behind the scenes, even though we're not able to see you in our office or come to your office as often as we have in the past. Know that we're taking this very serious and we're constantly trying to review what's happening and reassess, do we need to make adjustments? And there's a lot going on behind the scenes, but we do miss seeing all of you. I know I miss going out and visiting all of our clients, but I don't see any more questions coming in. If you have any, feel free to reach out. We're going to send a follow-up email to everybody that attended today with these slides and with a recording of this, so you can do whatever you need to or share it. If there's other people that are asking you questions and we can help them through things, we're always happy to do what we can to give people some clarity on how we approach investing and understanding tax strategies and things like that. So is there anyone else that has a question, or anyone from the True North team that wants to chime in and do any following remarks? Anything else we need to add?
I'll just say, Jake, thanks for putting it together, and thanks everybody for attending. And please reach out and get advice if you're taking any of these paths, particularly on distributions or allocation changes. Make sure that you run it by us, and that we really help you think it through so that you know all the alternatives. So anyway, thanks for the opportunity, Jake, by setting this up, and please reach out to us if you're in a position where you're trying to decide one way or another.
Okay. Thanks, Marty. Thanks, everybody.
Okay.
Have a good, safe Wednesday, and we'll talk to all of you soon.
Okay. Thank you.